The Alpha Horizon. Thinking different. Acting aware.
Welcome to the Alpha Horizon podcast from Algebris Investments. My name is Douglas Branson. I'm Head of Business Development. I'm very pleased to be joined by Simon Peters, our investment strategist. So as part of our regular podcast series, we would like to discuss the investment opportunities in distressed debt in Italian real estate. And by way of a quick history lesson for those not familiar with our business, due to Algebris' founder being Italian, two existing US investors came to us just over 7 years ago and asked us to set up an Italian non-performing loan business backed by real estate. Since then, we've purchased more than 4 billion euros worth of loans, deploying around 1.6 billion euros of equity across two different funds. We launched our third fund in December to take advantage of some of the post-COVID opportunities that we see available. So Simon, thank you very much for being with us here today. Can we start at the very beginning with a few quick-fire questions to help us frame the opportunity? So firstly, what is an NPL? Then why are the banks selling these NPLs at the moment? And also, why Italy?
Thanks, Doug. Well, an NPL is a non-performing bank loan. We in particular specialise in secured loans backed by real estate, which primarily means mortgages, as opposed to, say, credit card debt or non-secured lending. 90 days after a missed interest or principal payment, a loan becomes non-performing. Banks historically phone and send letters to their delinquent borrowers demanding payment, but due to death, divorce, taxes or general business problems, a number of loans remain problematic. Banks would then sit on these loans until some sort of resolution. However, during the global financial crisis, regulators noted that a lot of banks did not give out new loans because too much capital was being set aside for these problematic loans. So regulators introduced new rules penalising the banks the longer they kept problem loans on their balance sheet. So over the last 5 to 10 years, a market has developed for banks to sell these NPLs. Italy had one of the largest problem loan markets post the global financial crisis in Europe, and as such, some of the best opportunities reside here, with forced sellers, a large supply, and only a few specialists like ourselves buying. This, in essence, is the opportunity.
Great, thank you. So how do we actually make money on an NPL? What are the strategies we employ? And perhaps can you explain the timeline, the liquidity and the risks of buying NPLs?
So let me give you an example. A bank will lend, say, 100 to a borrower when they think the secured collateral is worth 120. Post the global financial crisis, a recession or problems with a business, the collateral is now worth closer to maybe 80, but would still need to be realised, which takes time and money. The bank makes a loss, therefore. However, it gets worse. Banks are increasingly forced to sell at a large discount due to the new regulatory rules. So banks are selling business loans backed by mortgages for often, say, between 30 and 40 cents in the euro. Our aim is to make an agreement with the borrower to repay, an extrajudicial arrangement, or, if that's not possible, to take the borrower to court, repossess, and then sell the collateral, selling for, say, 50 cents. We buy up portfolios of NPLs from the banks, and increasingly from the secondary market over the first 3 years of the life of a fund, and then we divest over the latter 3 years of a fund. Liquidity occurs as positions are sold or refinanced. Now, due to the collateral and the price we're buying at, probably the biggest risk is more of a timing issue. For example, if the court proceedings take longer than expected, we might see a delay in realisation of the collateral value.
Understood. So on to question 3. The pandemic had a negative impact on both Italian and European real estate markets. Can you please explain what actually happened and what the opportunities are looking forward?
The Italian courts shut down for 3 months last year, but there was a longer dated issue that even when they did reopen, they worked at a slower pace due to a number of related restrictions and delays to working practices. As such, this delayed both sales, auctions and agreements, leading to an elongation of the time taken to collect proceeds. Secondly, a number of property values dropped, especially if the business was linked to COVID-related vulnerabilities, such as the hotel sector. If a fund was expecting, say, a 9 or 10% IRR, these two impacts cost probably around a 4% hit. Of course, the flip side of that is that investing now potentially gives some recovery potential as real estate prices and activity recovers. And now we're at an interesting juncture. Real estate prices and activity do look poised for a recovery. Clearly, there's also been a strong economic bounce back globally with the easing of lockdowns and the successful rollout of vaccines. But specific to Italy, We witnessed Draghi becoming Prime Minister earlier this year, in charge of a broad coalition, which has provided confidence to Europe to spend north of 200 billion euros from the EU Recovery Fund, favouring Italy with greater than 10% of GDP to be spent on infrastructure, real estate, and reforming the judicial system. So both political and macro policy developments are likely to favour Italy in the coming years. In addition, we are seeing an increased supply of NPLs post the COVID recession and the increasing bank M&A activity in Italy, giving us a chance to cherry-pick the best deals.
Excellent, thank you. And the last question, can you just go into more detail about how returns are generated in the NPL space and perhaps talk through the lessons that Algebris has learned over the last 7 years?
If I look at the existing strategies and take out the COVID impact, the strategies are making close to double-digit returns. We have also decided to limit the size of any future strategy, as we've discovered that one real advantage is to do smaller deals where we make an additional 1% of IRR on average. However, the biggest lesson we learnt over the last 7 years is how important it is to have an aligned servicer. In 2019, we created a fully integrated in-house servicer with more real estate managers and lawyers, the two most important groups of professionals you need to manage agreements and the underlying properties depending on the strategies you employ. This has already led to the advantage that we charge the servicing at cost, which saves the end investor an additional 1% per annum, as well as providing more timely and better workout solutions, which we've already witnessed over the past year. We believe this provides then an additional 1 to 2% of IRR as well on top. Of course, there's always the potential of an increasing set of real estate prices and judicial reforms that we expect to benefit the end investor, and it creates additional buffers to the targets or further upside, which we don't take into account in our targets. Creating an in-house servicer puts us in a unique position against our competitors and should express itself in higher returns to investors.
Well, thank you, Simon, for sharing your thoughts with us today. To summarise, from a macro and political perspective, Italy is recovering and being provided with an especially large fiscal stimulus for years to come from the EU Recovery Fund. Real estate prices and activity are beginning to recover, but at the same time, Italian banks are being forced to divest large amounts of NPLs as they still have 1.5 times the average amount that the rest of European banks have. At Algebris, our 7-year journey has taught us the valuable lesson of having a more aligned and resourced servicer than the competition has using an outsourced model. We have been successfully operating with our new in-house servicer for more than a year now. If you'd like to discuss the opportunity further, please do get in touch. So thank you, Simon, and thank you, as always, to our listeners. Until next time.
The Alpha Horizon. Thinking different. Acting aware.